Good evening. Market overview. A highly unusual and volatile structural divergence characterized the trading session on Wall Street today. At the index level, the major benchmarks snapped their consecutive day-winning streaks, driven entirely by heavy institutional liquidation across mega-cap technology and artificial intelligence infrastructure providers. The tech-heavy Nasdaq Composite felt the brunt of the capital exit, plunging 1.5% to close at 25,881.95. Concurrently, the S&P 500 declined 0.51% to finish the session at 7,533.77, while the Dow Jones Industrial Average showed strong relative resilience, sliding a minor 105 points, or 0.2%, to settle at 52,552.97. Yet, these negative index numbers created a profound illusion of market-wide weakness. Beneath the surface, the CBOE S&P 500 Dispersion Index spiked to its highest level since March 2020, as a powerful positive rotation swept the broader market. In fact, nearly 3 out of every 4 stocks within the S&P 500 actually closed in positive territory, supported by a healthy, resilient corporate earnings season and solid retail sales metrics. The absolute strength of the underlying market rotation was validated by phenomenal corporate earnings reports, specifically within healthcare and logistics. Leading the winners column was medical device and pharmaceutical giant Abbott Laboratories, which soared 10.7%. Institutional managers aggressively accumulated Abbott after the company delivered a massive second-quarter profit beat and confidently upgraded its full-year earnings guidance, signaling strong underlying operational performance. In the transport and supply chain sector, J.B. Hunt Transport Services climbed a robust 8.0%. The logistics provider comfortably exceeded conservative consensus estimates for quarterly revenue, easing systemic Wall Street fears regarding a domestic freight recession. Furthermore, macro retail data provided a lift to consumer names, as non-gasoline retail sales indicated the American consumer remains highly resilient despite prior inflationary headwinds. Conversely, the concentration of capital inside massive AI infrastructure stocks meant that even a minor percentage decline in mega-cap tech packed an overwhelming punch against the cap-weighted indexes. Nvidia Corporation, the largest company on Wall Street by valuation weight, fell 2.4%, acting as the primary anchor dragging down the broader S&P 500. This valuation squeeze intensified across the entire memory and hardware layer, as institutional allocators actively unwound highly leveraged semiconductor momentum trades. Micron Technology dropped 5.6%, trimming its spectacular year-to-date gains, while Western Digital plunged 9.2% amid growing institutional anxieties that near-term memory pricing levels may have peaked. The selling even infected international bellwethers. Despite Taiwan Semiconductor Manufacturing Company reporting a highly lucrative, stronger-than-expected quarterly net profit, its U.S.-listed shares fell 2.3% as global portfolio managers used the positive fundamentally driven news event to aggressively lock in profits. An isolation of the 11 primary S&P 500 sectors beautifully maps out the deep internal mechanics of today's market rotation. Despite the S&P 500 closing negative, an impressive 8 out of 11 primary economic sectors finished the session securely in the green. The technology sector finished at the absolute bottom of the leaderboard, sliding over 2.0% as chip fund liquidations escalated. This was mirrored in the thematic fund space, where the highly concentrated VanEck Semiconductor ETF, ticker SMH, dropped significantly, tracking the severe downturn in its top hardware weights. In complete contrast, capital aggressively rotated into deeply undervalued cyclical value layers. Financials, financial services, and capital-intensive industrials received strong institutional net inflows, as allocators successfully capitalized on cheap, defensive valuations following the week's strong banking metrics. As we head into the final trading session of the week, institutional macro risk management requires a strict look at technical support zones and the upcoming corporate earnings calendar. First, monitor the S&P 500 at its current technical layer of 7,533.77. Having broken its near-term winning streak, institutional traders will watch to see if the index consolidates its gains or tests deeper structural support near 7,500. Second, the fundamental focal point shifts immediately to the mega-cap tech reporting cycle. Post-market earnings data from streaming titan Netflix Inc. will be scrutinized heavily by market participants. Analysts are looking past pure subscriber addition metrics to focus directly on ad-tier margin sustainability and forward free cash flow guidance. We advise maintaining a highly balanced portfolio stance. While tech momentum is undergoing a healthy and necessary valuation reset, the exceptional fundamental strength displayed by the broader market components suggests that this bull market is broadening out structurally. That concludes the update. We will see you at tomorrow's opening bell.